So good morning, everyone. It's great to see that so many of you have already joined in. Welcome back, everyone, to another session with Assetplus Academy on mastering mutual fund distribution. Now, when I say the mutual fund penetration in India is growing, honestly, that's not even accurate because it's not just growing, it's exploding. And today we are going to talk about why this is happening and why this is actually the perfect time for each one of you to build or scale your journey as a mutual fund distributor in India. And to break this down for us, we have someone who understands this industry inside and out, Mr. Sunil Subramaniam. With his rich experience in the mutual fund distribution world, in the mutual fund industry itself, he brings insights based on real numbers, real trends, and real on ground experiences. We're truly honored to have him as the strategic advisor for MFD growth at Assetplus Academy. He has already guided us in previous sessions, and today is another great opportunity to learn from his practical wisdom. So, without further delays, let's dive right in and get started. And as always, if in case you have any questions, please feel free to drop your questions in the chat. We'll take them up at the end. Over to you, Sunil.
Hi, thanks. And good morning to all of you. Thank you for dialing in. So, as the webinar is titled Mastering Mutual Fund Distribution, let me clarify that it's both for new wannabe MFDs who are evaluating the journey, as well as for those who are existing MFDs but seeking to scale up their businesses. So, I'm going to address both of you all in the same way because fundamentally the process is very similar. So what I want to first of all do is for the first slide is like to show it to the wannabe MFDs to give them a sense of the mutual fund industry itself. So can I have the first slide? Yeah. So what is this that you are at the exciting point of joining one of the fastest growing sectors in India, the mutual fund distribution sector? So just a couple of key highlights here. You'll be glad to know that this month of November, the industry crossed the 80 lakh crore mark. This has been a phenomenal growth because if you look at this 80 lakh crore, whether it's on average assets or on closing assets, it's a 6x growth over the last decade. And if you take over the last 5 years, also it's been a phenomenal growth of 3x growth. So you can see that this is a multiplier industry, right? When we talk about the power of compounding for the investors, we are talking about the compounding of the industry itself at a phenomenal pace, right? And what has happened is that this is not just from institutional assets or whatever. This is from a large number of retail people, right? So we have more than 20 crore retail folios. Of course, there is a little bit of double counting because I open a folio with X AMC, another with Y AMC, it gets double counted. But still, it means 20 crore active investment decisions being made by people, right? So, welcome to what I would say is a real old age business with a new age growth path. Okay. So, as we now look at it, what I want to show you is despite it being the fastest growing sector, the way forward for the industry. You're saying, oh, if something is already fastest growing over the last decade, then maybe is it going to slow down? So I want to disabuse any such notions and take you into the journey of what you would have heard, the journey of Viksit Bharat. So let's go to the next slide. We all know that we have set ourselves a goal led by the Honorable Prime Minister, that by 2047, 100 years after independence, we will become a developed country. Now, the long term growth prospects, right, that we talk about for the Indian economy, let us dwell a little bit on that, right? So, first of all, we are already the fastest growing major economy in the world. The graph on the left shows you the line of India is head and shoulders above the rest of the emerging world or the advanced countries or the United States or the European Union. We are clearly the fastest growing country in the world. And on the right hand side, What has this led to? In the last 10 years, India's GDP has shown a 100% growth, which is again, as you know, United States has grown at about 60 odd percent, China at about 76%. We are head and shoulders above the two major competitors, if you look at it, right, which is United States and China. So clearly the growth of the industry is just mirroring the growth of the economy. Now when you move to the next slide, right, you will see that from a ranking perspective, what has this growth led us to? We are the fourth largest economy in the world. Now, as you know, the GDP numbers which are representative are all nominal GDP number. That is real GDP plus the effect of inflation on our economies. So we are just about at touching with Japan. We, because of the currency, sometimes we are ahead of Japan, sometimes we are behind. But clearly, I would say we are, because we are growing much faster than Japan, it should be no doubt that we will secure the fourth rank very, very shortly. But also, I also want to point out is that the inflationary aspect, if you try and remove it, there is something called as the PPP business, which is purchasing power parity. Just assume that all goods and products are the same price in all the countries. On that basis, we are already the third largest, following on China and the United States. So we are clearly not only the fastest, but among the topmost countries by GDP, whether measured by nominal or on a PPP basis, right? And now, when you look at the future growth, this is all about the past to where we have reached today. So, in the next slide, you will see that our growth for the next 5 years, if you take a 2025, we are at about 350 in terms of the size of the nominal GDP trillion, and we should grow 50% by just the next 5 years, the economy to a 550, right? Or you'll say, oh, that's great. 50% growth over 100% growth over the last 10 years and another 50% over the next 5 years, which means you're maintaining a pace. But hold your breath. This is nothing compared because our economy is still in a formative stage. We are still dependent on a lot of government spending, private capital expenditure, private consumption. All of these are yet to kick in. There's a lot of effort going on to improve our manufacturing because we are a services driven economy. So if you look at it, right, manufacturing, private consumption, and services, these are the three main components, right? We know we are very good with the IT services and the overall services play, we are very good. In the manufacturing, we lag behind China. It's also common knowledge. So the combined of these three is what is the nominal GDP. So with all the efforts being put in over the last 10 years and the next 5 years, while we will reach a 50% higher growth rate, the next decade, and people call this the golden decade that we are living in. I would like to call that the diamond decade. That is 2030, 2040. You won't believe it. From 548, we are going to quadruple in size by 2040 to 2205. And by 2047, it will be even higher. But from a reasonably near term perspective of the next 15 years, right, we are going to see a phenomenal from a 350 levels now to 2.2, which is almost a 8x growth. So the key thing why I want to stress is when you are going and seeking customers and you're telling them the long-term story of India, it is this growth path, this escalating growth path. You see the slope of the increase is going to sharply go up in the next decade. So all the investments that you garner from customers today will show some results over the next 5 years, but it's the next 10 years which is going to show phenomenal results for your customers and for your assets, right? So that's the picture of the nominal GDP growth. Now, as you move on to that, so hence, I would like to partition our growth of the nominal GDP. And there's a reason I keep telling nominal GDP, just hold your breath and why I'm focusing on nominal GDP, that we should expect to grow at about 10% nominal GDP. You saw this year's data showed we are growing at about 8.8. That's because the inflation has come in very low. That's not a sustainable feature because we had very good monsoons back to back. So as it normalizes, inflation should trend up a bit. And I think a 10% nominal GDP growth, right? So which has come from what? The 6 to 7% real GDP growth and around 4 to 4.5% inflation. That's the story of this decade. But when you go to the next decade, as I spoke to you just now, you can see that our growth can escalate on a real term to 8 to 10% from the 6 to 7. And the inflation also will have to keep pace, because as the economy grows, as demand grows, inflation will come to a stabilizing level. This 2 to 3% inflation is not a sustainable one, nor is it good for corporates, right? Because they would like to see a nice growth in the product prices so that they can invest in future capacity creation. Right. So if you now look at that in the next decade, from a 10% in this 2020 to 30 decade, our growth rate will go to a 13% annualized growth in the next decade, right? So what does this imply now? What it implies is that over a 15-year period, if you take the weighted average growth, you can expect countries' nominal GDP to grow at 12% from 2025 levels to a 2040 levels, right? So the reason I said this is, and hence, this is the growth rate. But where will that take us to as a country? It will take us to $10 trillion by 2036, 20 trillion by 2050, just after we hopefully attain Viksit Bharat, and a 50 trillion GDP by 2075. And we are talking today of a 4 trillion economy. So you can imagine the scale of our growth. And if these projections hold good and everything materializes, we should be in a happy situation that we might actually overtake the US by 2075. Yes, it's a long journey, and I don't think we will still overtake China, because China continues to be growing at a fairly decent and robust rate, right? So with that picture in mind, right, that we have a 10 trillion, 20 trillion, or 50 trillion GDP as a part of our growth milestones, we now move to the Indian stock market, because ultimately, as distributors, you are going to take your customers' money and put it in the stock market. So how does this economic growth future, right, a quadrupling of the GDP over the next decade and all will translate? So let's look at a bit of history. So if you take a longer term history, and what's shown in this slide is that not for just our economy, you take the China economy, you get the South Korean economy and the Indian economy over a 15-year time span. The reason I stretch this 15 years is you can see there are two lines in each graph. There's a straightish line and then there's a jagged line, right? The straightest line represents nominal GDP, because either it grows at 9, 10, 11, or 12. So the variability is not much. But the stock market, as you know, is not a function of just the nominal GDP, though it directionally tracks it over the long term. In the short run, there are demand and supply. FIs come in and go out. DIs buy, sometimes don't buy. So this leads to volatility. So over a short term, you will find that, for example, last year is a classic example where we saw that the economy was growing at about 8 to 9% nominal GDP, but the stock market did not deliver a commensurate return, especially the broader stock market. So these things happen in a life journey, right? But when you have a long-term goal of 15 years in your mind, you see that the stock market's overall market capitalization growth always beats the nominal GDP growth of that respective country. I don't know whether you can see those numbers fairly clearly. I'll read them out to you. South Korea had a nominal GDP growth over the last 15 years of 3.6%, but their stock market cap grew 6.8% per annum. Correct? So an additional growth of almost 3.2%. China had a nominal GDP growth of 13.2%, but a stock market which grew by 18.5%. How much is the difference? 5% plus. The stock market has beaten the nominal GDP growth. In India, over the last 15 years, the nominal GDP has been averaging at 8.4. Like I said, inflation has at times tended to be low, but still, our market cap growth has been 9.7, a 1.3% alpha. So just to let you know, that 12%. So now as you move to the next slide, you can say that the stock market for the future should outperform. You've seen the kind of outperformance that Korea has shown, China has shown when they have got their manufacturing act together. As we are also working towards that, I think that from a 1.3% that the market cap beats the nominal GDP growth rate, for the future, for the 15 years, we can expect at least a 2% beat. So if the economy is going to grow for 15 years at 12% nominal GDP, I think that the stock market has a capacity to deliver a 14% per annum CAGR over the next 15 years. But you got to wait for the 15 years. Don't expect that like a bank fixed deposit. Every year you'll see your 14% growth in the stock market. There will be times when the market grows 30%. There are times when the market actually corrects. There are times when the market is flat, or sometimes the market underperforms the nominal GDP. So you have to allow the curve to play out because there are business cycles. And over a 15-year time frame, you can expect at least a 14%. Now, is this backed by any evidence? So there is something called as the rolling returns analysis, where you do 15-year investments or 10-year investments or 3-year investments every day of that period. And what I've done here is for the Nifty. Over a long-term period, if you look at the rolling returns analysis, the number of periods, for example, for a 15-year return is 3,400 periods that you have taken this data. And believe it or not, the average return of the Nifty on a rolling return over a 15-year period has been 14%. So what I'm trying to say is that already our markets have demonstrated that it can beat the nominal GDP, and 14% is a reasonable ask. So in projecting a 14% for the next 15 years, we're not going to be wildly off the mark. In fact, it should be better. I just want to be conservative, right? Because the economic growth is the next 15 years is going to outbeat the economic growth of the last 15 years, right? So with that in mind, right, you look at the potential for a maximum return. That is when the timings were right for a 15-year investment, you delivered from the Nifty 19.4%. The minimum, when your timing was wrong, when you invested at a market high, you still got 8.5% per annum return. On an average, it's been 14. So I think that if you then look at the next 15 years, we are still at the cusp of a growth. So it's not like we are already at a very high level. I know valuations look rich now, but our growth rate will justify those valuations, right? So with that 14% broadly in your mind for the broader market, if you now go forward and look at it, fund managers are expected to deliver alpha. So over short periods of time, again, just like the stock market growth with the nominal GDP growth, sometimes fund managers don't beat it, sometimes they beat it. But again, over a longer term period, because they take these bets on these stocks over a 3-5 year outlook, you see that initially the stocks may not perform to the expectation, but by the time you wait out for the fund managers thought was to play out, they do end up outperforming. So again, I'm being reasonably conservative in assuming that overall stock market, because alphas in the small cap and the mid cap should be better than the large caps generally. So to that extent, I'm taking a 2% as something that you can reasonably expect it, provided you wait for a 15-year period. I'm reiterating that point again. So mutual fund should deliver a CAGR of 16% per annum over the next 15 years, right? So with that in mind, right, what does the future hold? Well, again, we don't want to go into 2040 or 47 for that. Just by 2030, we think that this 80 lakh crore should easily cross the 100 lakh crore mark. I think it will far surpass that. But just to remain conservative, that there is a 100 lakh crores, that's 100 trillion opportunity in front of you in the foreseeable future. What it will be by 2040 is a mind-boggling number into which we'll try and deliver at the end of this session, right? So as we now then go into what all of you are in for, which is mutual fund distribution. So based on this stock market growth and the mutual fund industry's growth, what does it hold for the distributor, right? So when you look at the next slide now, the long-term growth prospect for the mutual fund distribution, what are the factors which are going to favor this? So the first thing is that per capita income is going to rise as the economy grows. We were in 2008-9 around $1,000 per capita. Around the 2020-21 time, we reached the $2,000. We are at the cusp of $3,000 today, 2,880, 90, depending on where you take it, right? But by just the next 5 years, this is going to go up by almost $2,000 more, which is what? 2,000 by 3,000 is 66% growth in the per capita income. Holding on this slide, why is this a focus? Because when people earn more money, their expenses do not keep pace. Because there are basic needs with a lower per capita income that you have to fulfill. But as you go up, you go into discretionary. That is a choice of what to spend. But as your income grows, you cannot possibly be spending all of that income. So savings also gets triggered. And it is this increased savings pool that you are going to be competing for with other asset classes, right? So, but we all know that the primary way that people put their money is in banks, because our government has supported the banking industry in a phenomenal way and has barely allowed any large bank or a decent sized private or public sector bank to fail. They're always protected. You are also protected by the Deposit Insurance Corporation. So there is an immense trust in the banking system. So just to demonstrate my point, that as incomes grow, savings grow faster. The next slide shows you that in the previous time, that is from 2012 to 22, when per capita income doubled from $1,000 to $2,000. Can you believe it? Bank deposits overall, that is CASA, that is current account, savings account, plus fixed deposit, term deposits, went from 64 to 170, 3x. So a doubling of per capita income made a tripling of bank savings, right? So why I'm saying this is, so as per capita income grows, people's ability to save, their propensity to consume will be less as a proportion of their income. Absolute consumption will go up. People will buy bigger cars, bigger houses, yes, but not to the extent they will spend to the extent of their increase in the income. It's a very important point for you to note that what has already happened is nothing compared to what is going to happen as our per capita income doubles, right? So the first thing is that bank deposits have risen disproportionately at 3x compared to doubling of per capita. So in the next cycle, when it again doubles, right, roughly from 3,000 to 5,000, maybe in another few more years, maybe 6,000, you can expect that bank deposits will grow. But are the competing asset class like mutual fund and insurance going to allow everything to go only into bank deposits? Because these were all nascent industries in the last 10 years, growing fast, but still a small proportion, as subsequent slides will tell you. But let me go to the next slide to tell you that the change in the perspectives. There was a poll done by Ken where they asked various people, what is your propensity to put in a FD? As you can see, the younger the population, the lesser the charm of an FD. So that's on the left-hand side graph. So as you know, India is already the second youngest country in the world, and demographic dividend, in fact, speaks of our youth coming to the fore in terms of manufacturing, and they will be in the consumption and in this savings basket. That is already happening, because if you look at the right-hand side graph, right, bank deposits, mutual funds comparison, what is the proportion of mutual fund to bank deposit in the country? In 2014, a decade ago, it was only 10.7%. Today it has crossed 31%. So already in the last decade, the mutual fund has tripled as a proportion of bank deposits. So do not be surprised that in the next 15 years, it's probably going to be equal or not better than bank deposits. So the potential arises from taking people's money from the banking system into. And why are we talking about this? Not just we want to snatch the business. It is the fact that the bank FD rates or the savings rate, obviously not the current account rates, are no way going to match the inflation in the country. So bank deposits, by their very nature, at best protect from inflation or actually get destroyed a bit in their capital by inflation, depending on time periods that you observe. So the mutual fund industry, as you know, through equity assets has got the best competition to beat inflation, right? So that is the reason this has been growing partly, and the stock market's growth, because these are absolute assets. But for the future, you can say that people's thinking is also changing, people's actions are already demonstrated to be changing, and hence there's a huge potential for you in the future, right? In terms of the doubling of per capita income and the penetration of mutual funds. So where the opportunity comes, this per capita income, when it grows, one of the things to realize is that not everybody's income goes. So when you say from 1,000 to 2,000, or from the 2,000 to 3,000, 1,000 to 2,000 or doubling, it is not that every person in the country's income doubled. Whenever these per capita incomes rise, there is a polarization. Some part of the rich will get richer. The poor are not going to get poorer, but in a relative sense, they get less of the increase. This is what I want to demonstrate through the next slide, where if you see in the country today, if you take the total income of the country, the top 10% of people, which is in a 140 crore population, 14 crore people earn 60% of the country's income. So the balance 90% of people only account for 40%. So why I'm saying this is when you're looking at a customer, the potential from the middle class, mass affluent, HNI, UHNI, and the rich is far greater. So when you go and pitch it, you got to be conscious of the category of the person from an earnings perspective. And in fact, this polarization of income year upon year, on the right side of the graph, you can see that wealth wise, 80% of the country's wealth is controlled only by 10% of the population. So they earn 60%, but the compounding of that 60% earnings over a period has led them to build their wealth so that there's a centralization, polarization, right? That the top 10%. Now, this doesn't mean that only the top 10 should be your pitch, because there are bankers, there are wealth managers, there are alternative asset managers, all pitching for the wealthy rich. But when they go richer, the others also grow. The only thing is they're not growing as richer, but everybody's income goes up. This I will demonstrate through another slide, where I say that while we have seen that the rich have got richer, it doesn't mean the poor have got poorer. We have been recognized even by the World Bank as where the poverty levels have dropped dramatically, partly because the government has now made sure that the income leakage by direct benefit transfers has gone down. So we have pulled out 124 million people above the poverty line. So it's not that the poor have become poorer, it's just in a relative sense, the poor's income has also gone up. And so there is a potential for mutual funds in the entire set of the population, right? And when I then go to the next, I'm trying to do in the next slide, a segregation of this population. So you can see there are 5 rows there: elite, affluent, aspirers, next billion, and strugglers. This is just complicated language. It's nothing but if you go from bottom up, it's the poor, is the lower middle class, it is the middle class, and affluent, you can call them as the HNIs, and elite as the UHNIs, ultra HNIs, or the rich, right? Why I want to point out is the effect of this polarization as per capita income doubles. Right, so 2010 to 2019, it doubled, right? You saw from 1,000 to 2,000. In that period, see what has happened. The poor people have gone from 33% of the population to 22% of the population. So 11%, of the people have been lifted out of that struggler bracket into the next. But whereas the sharpest growth's been, the ultra HNIs have gone from 3 to 10, that is 1% to 3%. The affluent has gone from 5% to 9%, almost doubling. And the aspirers have gone from 15 to 21. So you can see that this polarization happens. While people are lifted out of poverty, the sharpest change in brackets are at the top. Now, when you then look at it from a 19 to 30, where again a reasonably a doubling is expected, then you will see that this process will go further. So further, the poorest people will go from 22% of the population to 11% of the population. But the increases will be in the middle class and the upper middle class and the affluent and the rich, right? Why? If you see the writing on the right-hand side outside of the table, the top 3 buckets, which is elite plus affluent plus aspirants, which are probably the main categories for mutual fund as an asset class, right? Should increase today from 33% of the population to 50% of the population, which means that potentially out of the 140 crore, and which will probably go to 160 crore by 2030, or maybe 150 crore, right? You want to put a number to that, but half of that is a potential investment universe for all of you, which is you're talking about 75 to 80 crore people. So they will have more money, and so they'll have more to save. right? So now when you move to the next slide, it summarizes this in a nicely different way of households. In household means husband and wife both put together, right? So all I'm going to say, just in the next 5 years, number of households earning above $35,000, which is let's say 29, 30 lakhs. You can say that a 30 lakh household income, he'll have enough money to save and decide on where to put and what to put, right? That is going to grow from 5.6 million households to 25 billion, which means just in this, what you would say, in a reasonable growth rate period up to 2030. Because what will happen from, you can project what will go from 2030 to 40 then. It's going to be a 5 times multiplier of the potential households which can invest in mutual funds, right? So then when you move on, right, the future to project for that is China is a good example, because China is already at $13,000 per capita income, which is what we should be aspiring to go towards. So if you see, India has 27 million households in that middle bracket, the middle class. China has 150 million households. So if you look at it from that perspective, right, that's a 6x growth potential in just the middle class, right? So I hope the future promise in terms of the opportunity is very clear to you, right? And that's why I say beyond 2030, the next slide tells you that this is going to get even sharper, the polarization. So the topmost red bracket, don't read the numbers and all because we use similar terminology, right? Is that you can see that the red is going to expand tremendously and the pink, so which means you can call this the rich and the upper middle class are the ones which are going to expand. So have no doubt that the potential investment universe in terms of number of people is going to phenomenally explode, and so the potential for you to then succeed is that much higher. Okay. So then when we conclude this section of the presentation, right, the next slide, we can see that if you want to put a vision for mutual fund for 2047, we can talk of the MF AUM itself going up 52x. We can talk of the investor base going up 6x, right? Which is what we saw. 6x is the Chinese, middle class multiplier of us. But the mutual fund RIA universe will multiply 6.2x faster than the investor base, because the money they have will be much more. That's a polarization. So be ready for a 6x multiplier in the MFD, assets under management. That's the field in which you're going to go and play. Place your wicket, take your stance and bat, right? So now, from the opportunity perspective, this was the scale opportunity. But in terms of the potential to penetrate, I want you to take up the situation that for all of this being the fastest growing, the next slide, please. Next. For all of our fast growing size over the last decade and the last 5 years and all of that, our mutual fund industries AUM as a percentage of the GDP is only at 17%, which is a quarter of the world average, which is 74%. So we have to grow our industry 4x just to reach the world average. So clearly, it's not a job half done, it's probably a job quarter done. The glass is only quarter full. Three-fourths of the glass is yet to be filled. Right? So in now when you look at it in terms of number of people, because that was as a percentage, AUM as a percentage of GDP, what you see on the slide. The next slide tells you that in a 140 crore population, almost everybody has Aadhaar cards. Almost everybody uses the internet. Almost everybody has a mobile. But if you go and search for stock market users, that's only 12 crores. And within that, if you look for unique mutual fund, we talked about 20 lakh folios, right? But if you 20 crore folios, but as I said, there's some double counting there. If you take out the unique PAN numbers who have invested in mutual fund, it's only 5.7 crores in a 140 crore population. And with the polarization of income, people going out of the poverty line into lower middle class, from lower middle class to affluent, and affluent to HNI, in that journey is where this 5.7 crores has a huge potential, because there are still 135 crore people who have not invested in mutual fund, right? So have no doubt. And in fact, 12 crore stock market users, people have, the young youth are willing to open demat accounts and buy stocks. But the discipline process of mutual fund investing has yet not there. So our first target is to convert these stock market users into mutual fund customers, because they are more almost double. They are double of the mutual fund folios. And then you also talk about expanding into the people who have neither experienced the stock market nor mutual funds. So in the next slide, right, because we are attempting to talk to people from all over India, the potential for this stock market investment penetration, right, is phenomenal, whichever state you take it. Yes, Gujarat and Maharashtra are leaders of the pie. Maharashtra badly because of Bombay, right, and Gujarat has a 10%, but that's the highest. You take any of the other states, right? There's a huge potential, right? Karnataka, because of Bangalore, is at 20%. But the potential for each one of you, whichever state you belong to, even the stock market, we are talking about the 12 crores demat account users, even that shows that in each and every state, and in fact, many of you have states where you have barely scratched the surface, like Assam and Himachal and Punjab and Haryana are at 2% and 3%, right? And even in a place, high potential place or high penetration place like Gujarat, it's still only 10%. So the potential is huge in terms of getting new people into the mutual fund industry, right? And now we go and see, why is it so low? Why is it so low? So where the hell are people putting their money? If they're not putting it in the stock market, they're not putting it in mutual funds, where are they putting it? It's intuitively, all of you know the answer. So in 2016, if you take, 56% of the people had put their savings into property, either apartments or land. 56%. Another 13% had put it in gold. So that's 69% of people's money was in physical assets. That's where people are, and that's where your main target audience is. Now, from 2016 to now, there has been a shift. It's that same 56 plus 13 is now 51 plus 15, which is 66. So you'll say, oh, big deal. From 69%, it has come to 66. We have not made any progress. No, don't look at it that way. Just 3%, right? That's a drop of the others. So if you see from the base effect, right, 3% is a huge shift. But that's not enough, right? Because we have to wean people away from trusting the physical. Now, there are multiple reasons why people in India trust the physical asset so much. But the good news here is that the industry has made a big move in terms of financializing these physical assets. So in the case of gold and in silver, you know that gold and silver ETFs have gained in prominence, and you've seen a rapid increase in number of people putting their money now in gold ETFs. And as you know, gold ETFs are managed by the mutual fund industry, right? And not only as a part of the gold ETFs, it's also there in a category called multi-asset allocation funds, which put a portion into commodities like gold and silver. So we in the mutual fund industry have made an attempt to financialize even the physical assets, and that's the progress that you're seeing. But it is our responsibility to take this even higher. Yes, people have a liking for physical assets, but why not buy those physical assets in a digital paper form through you as a partner, right? So, first of all, while you may say, oh, the story is very depressing because 69% is 61.6% is already there. No, 60% is the potential for you to go and talk to them. And now I'll tell you another story about what has happened in terms of a recent guideline change. So the industry has made an effort to financialize even property through REITs, real estate investment trusts, and they're already been included in a lot of hybrid schemes as a asset class, right? What is a real estate investment trust? Very simple. A commercial property is given on rent to big corporates. What they do is they discount those future receivables in a form and sell that paper to multiple people, and mutual fund subscribes to that, which means that as a REIT, when it invests, you get the regular rental income, plus the rental income also keeps pace with the property appreciation. So you get the property inflation plus the income, but in a paperless form, you can buy units for very low rupees. You don't need to go and put a crore or 50 lakhs in a property. So the REITs has been gradually growing in terms of mutual fund allocation, but recently the regulators have given the status of equity assets to REITs. This will make a huge difference going forward because fund managers can now put in their equity funds a REIT component. So the demand for REITs will go up, and with that, now you will expect over the next year or 2 years a dedicated equity fund which is only a REIT fund. So again, that's another weapon that you will have in your hands to tackle this fascination for real assets that people have, to get them into the mutual fund fold, right? So first is that the industry is today much better prepared than before to tackle this and increase its penetration. So you're joining at a very excellent time when you know the returns that gold has shown, gold ETFs have shown. So, and through multi-asset allocation funds, you should be able to make a penetration and a dent into the physical versus financial mix, right? Now, the next thing is within financial also, we have a battle. So now when you look at what people do with their, in the next slide, with the financial assets, believe it or not, 60% of Indian households' financial assets are parked in low return options. What is this? 32% are in bank deposits, 7% is cash. Despite demon and everything, people still holding 7% in cash. And you can see only 6.7% is in equity mutual funds, 2.7 is in debt and other hybrid funds probably, right? And pure equity is, direct equity is about 9.7%. But if you look at it, right, the potential for us to shift that 32%, which is in deposits, plus 7% in currency, 40% is in non-inflation beating assets. So first is to wean them away from physical into the financial world through gold ETFs, multi-asset allocation funds, and through REIT-based investments. But the second is that you need to tackle, you have a potential to tackle a 40% of the investment of the people is not keeping pace with inflation. That's your biggest selling point, which you can use. And so the opportunity is phenomenal in terms of this, right? Now, next. So, to summarize, right, there are two sets of opportunities. Because if you notice what I've said, right, when you look at the MFAUM as a percentage and look at the number of people, first is expanding the customer base from that 5.6 crore unique PAN numbers is expanding the overall customer base. But even the existing, as you saw in the slides before, lots of people have given money to mutual fund out of the 5.7 crore, but very small share of the money. They've still put 60% in physical assets. They still put 40% of it in low yielding assets. So you have a potential to penetrate even existing customers, equities investors, because you know the equity investors are already 12 crore compared to 5.7 crore unique PANs in mutual fund industry. So you have a potential to get into existing equity investors who are already familiar, but get them to diversify into mutual funds. So there are two clear streams of actions. And how do you go about this action? First of all, from expanding a customer base, I've just put out my thought process here on, as an MFD, how do you go and increase new customer acquisition? I don't know, the slide is very clearly visible. So give me a minute to enable you to read it. I will just read through quickly. Building a personal brand, because that's very, very important. People are putting money in a trust to you, right? So building a personal brand is important, which includes competence, right? Obviously, and publishing articles and papers and writings about it. Second is marketing yourself as a person. Put up a hoarding with your picture in your locality, for example, right? In your small locality, micro locality, right? Next, technology absolutely is critical, right? I'm sure Asset Plus has got a lot of technology tools, and they'll take you through some of those at the end of this presentation and guide you if you so need the guidance, right? And then you have to corporate yourself, because people should not think, oh, it's only you as an individual. You have to create the support system that they know that there is, even if you are not present, that there is somebody to service them and take care of them. And then what do? When you want new customers, the best is to look at home. Has your customer's son or daughter invested with you? So first step in expanding is get to the near and dear and the friends and the connects and the family of your existing customers is the new customer for you, right? So this was my brief 2 bits in terms of that. The next one is your existing customer's wallet. How do you go about doing that? Here, of course, you have to become his life financial coach. What does it mean when you say life financial coach? You will have to advise them on his bank deposits. You will have to advise them on his insurance. You will have to advise them on his estate planning. Because then only he will build the trust and he will open it up. And then it gives you an opportunity to go and tell him how much he's losing on inflation. Today, what happens is, because people go and market only the greed-based products out of fear, they keep their money and they don't even reveal it to you. So building that trust is important. And of course, excessive use of technology scares customers away. Daily WhatsApps every half an hour or something. No, don't get into that WhatsApp university mode, right? And of course, as you equip and build on skills and qualifications, he will also feel that you become, valuable to him. And you should use the AMC's experts, leverage them, get the fund managers, economists, product managers, for all of them to hold a webinar for you exclusively with your client, so your credibility also improves. And then you have to create a succession plan, because in the existing customer, if he's going to give more and more, he's worried about what after you. So clearly identify, either you are able to persuade your son or daughter to join you in the business, fine. Otherwise, get a trusted person to whom you will hand over the business, communicate that to the customer. Only then the trust level will improve. So that was my 2 bits. But finally, I want to come to the fact that you have to use asset allocation as your primary tool. Why do I say this? Because we are either trying to get new people in, or you're trying to get more money from the existing people, right? So there, if you see, assessing the customer's risk appetite is absolutely critical. One of the reasons we have only got 5.6 crore people, because people are scared of the stock market. So if you go and keep talking greed, you're going to completely go above their head. So you've got to understand the customer's risk appetite first. And this is not some complicated, banks do a lot of questionnaire and all. You don't need to. You can easily understand by talking to the customer how risk averse he is or how comfortable he is. Just put a aggressive, moderate, conservative label to a customer in your head. But the reason I point out this as a fundamental thing for you to do is because in the next slide, I'll show you that the mutual fund industry has products for all risk return profiles. A competition for a savings bank, to a competition to a fixed deposit, to an aggressive investors thing. So we have the entire range of products, including a newly introduced SIF category, that is the specialized investment funds. And that's what I mean by asset allocation. Choose the right mix for the customer's risk appetite. First understand the risk, then pick the product bouquet from this. The mix changes. To a conservative customer, you will take obviously much more of the bottom. So when I go there now, I tell you this. So first of all, do you know that savings bank not compete with a mutual fund product called arbitrage funds and liquid funds? The next slide, please. You're stuck on this one. Right. So you should persuade your customers from a say, no, this is, you're going to the one more slide, ma. I missed a slide. Yes. Okay. So even a savings bank account, you can convert to a liquid. And let me tell you that many AMCs in their liquid offer you 50,000 rupees spot withdrawal you can do per day, right? So any emergency needs, he can draw cash immediately, right? Same day. But there are products like arbitrage, which even take care of the tax efficiency because they are equity taxation. So the person keeps extra cushion in a savings bank. But an arbitrage in a T+1 or something, he can shift that money whenever he needs it. So it's the level of trust that to tell him that he's not going to lose his money in these categories. And over a period of 3 to 5 years, they have delivered I would say past track record says they delivered double of a savings bank return on a post-tax basis. I'm not saying necessarily that past performance will follow in the future, but the past track record is there to help you to position these. So my first lesson to you is don't just go and talk greed products, talk safety products, which are there in the mutual fund bouquet. So target his savings bank account with liquid arbitrage and low duration funds. Next slide. You can target his bank deposits with the hybrid category where you have different risk reward ratios. Equity savings is the most safest, followed by the dynamic asset allocation funds, maybe an aggressive hybrid funds, and then the multi asset allocation funds, which are including commodities like gold and silver. These are very competitive to bank fixed deposit in terms of returns over the medium term, and they carry a tax efficiency which improves their if the attractiveness even more. So in the next slide, you will see that fixed deposits can be easily countered through these hybrid funds, right? And the next slide, I've shown you why. Because from a tax perspective, bank deposits used to have this ATC tax benefit. They still have, but the new tax regime has taken away the ATC category. So there's no longer a tax saving to a bank FD for a 5-year period, which is there. But the equity taxation for a lot of these hybrid products means that compared to a 30% plus tax rate on his FD, you are going to be offering 20% on a short term and a 12.5% long term. So that tax advantage itself makes them on a post-tax bill give a much better return than FDs. But many people don't target this systematically. That's one advice to you is go after their FD balance with the hybrid category because they are reasonably safe. You can choose according to that, equity savings funds being the most safest, conservative hybrids, but don't carry equity taxation, right? So next, when you go, right, is the where we talk about the existing equity investor who's already comfortable with the risk. What do you do with him? The alpha. So there are passive investors who just buy stocks, right? If you go to the next slide, please. You just buy stocks. The first thing you have to tell them with that is that next slide, please. Is that just buying and hold a stock doesn't work because what I've shown there in that graph there is 1996 when the Nifty started. What are the companies there and what are the companies in 2024? In the middle, you see the black portion. Those are the only companies which were there in the Nifty in 96, which continue to be in the Nifty today. All the rest have disappeared. Now, this is the largest cap of the country, right? Which means they've all slipped in terms of their ranking. So just buying and holding a stock is not going to work even over the longest term. So the first thing I want to point out with this, and the next slide, I want to tell you that the direct stock investment, there are excellent companies which I've listed there. I don't want to name them, but which over the last 3-4 years have given negative returns. And some of which have given less than 10% return. So individual stock picking, even though it's a very good company, the market price doesn't always reflect that in certain periods in time. So even for a passive who just says, I'll best buy stocks and good companies and live with it, you have the case to make that mutual funds give a much better return. So the first thing that you do to an existing equity investor who's investing in stocks is to show these kind of performance slides. Next slide, right? To an active investor who's managing his portfolio actively, so obviously not a buy and hold investor, and he will be actively managing his funds between active funds. And next slide, please. Between active funds and passive funds, right? So you should also see what happens is that many distributors tend to avoid passive funds because they feel, oh, the commission is less. No, you have to understand that if a customer is actively managing portfolio, he will look at some time at the cost level. And even in passive funds, it's not zero brokerage. There are regular plans in passive funds which give you some level of brokerage. But if you want to win a customer's trust and get all of his money in or greater share of wallet, you have to talk to what he is interested in. So a cost conscious customer who's actively managing a portfolio, you have to offer a passive bouquet. And there are sectoral passives that you can offer. There are large cap passives you can offer. There are a number of ETFs and index funds that have come. So you have to become an expert in passive. Yes, it's at a lower income, lower trail commission than an active fund, right? That's okay. You are only going to get more money from him, but at a lesser profitability. So the question is about profits versus profitability. So don't ignore passive funds in pitching to your customer. Next. Again, tactical. To the active investor, he's interested in sector, he's willing to take the risk. So his from when his risk appetite is willing to take risk, you have to become a master of some sectors. And no, you know the GST cut led to the consumption, right? You know that the private capital when it picks up will lead to infrastructure. So tactically allocating a portion to sectoral funds is the way you can manage your active customers. You can't say no, no, no. I will only do flexi cap and large and mid cap and those safer categories. No, you have to an active investor to pick up your knowledge so that you make tactical sectoral allocations also. It's a type of investor. These are risk comfortable investors. Remember that. Next slide, please. International assets. Again, a space. Now, international assets, you know that many mutual funds have stopped because of the RBI limit being reached, but there are still some which take. And now in Gift City, there are options opening up for people to invest. And you should be advising. My point is that even if he's going to directly go buy stocks, these active investors are buying stocks directly to various platforms. But you have to understand that, guide him. It's okay if you don't make money from that investment. He's anyway going to invest. But if you advise him and guide him, your trust is going to improve. And later, when in Gift City and those funds come, you can pitch those. There is also will be a fairly decent trade commission. But your knowledge about international assets is equally critical. So knowledge is again very important in dealing with an active investor. Next one. Obviously, the new category called specialized investment. Again, it's not that a customer just has money. So because the minimum is 10 lakhs, you put it in. These are only for sophisticated investors. So you have to understand these products in their true profile. Obviously, when you have a need a special qualification to be able to offer these products, that itself will give you knowledge. But knowledge is absolutely critical here in terms of how long short funds are managed. Again, for an active investor, you have to get this knowledge in your bouquet, right? Next slide, please. And it doesn't end with this. Your alpha, you can create alpha for the customer by choosing the right fund managers. Why do I say this? Yes, there are flexi cap funds and flexi cap funds. Which one versus the other? Many points are there, but the next slide shows you that a particular point in time, when we took a 1 year period return, right? The top performing fund was 22%, the worst performing fund was 15. That means what? We are talking, as we go to the next slide, we are talking about a 35% performance gap in the same diversified category between the best performing fund manager and the worst performing fund manager. So your job doesn't end with what I just said. It is to understand the fund manager, his style, his thought process, why he's doing what he's doing, and then pick it according to your customer's needs. So that's the final point in terms of what value you as an MFD can add to the customer is to choose the fund manager right for that particular points in time for the period, right? Now, when you go, right, you will see that one of the criteria there, for example, is a young gun versus an experienced marksman. Why I'm saying this is because the industry has been expanding, lots of new AMCs have coming, funds have grown in size, a lot of new people have joined. So you have to take a tactical call that in a maybe in a sectoral fund, a young guy comes with bright ideas, he's a better bet. But in a traditional fund, an experienced markman of an experienced fund manager is good. So it's not that all experienced are good and all young guys are bad, nor the opposite is true. So, but the age is an important factor because in what type of fund and what ideas you're selling, that's an important criteria in choosing a fund manager. Okay, the next slide, please. Right. And finally, the true value of an MFD is that when your customers are going direct and investing in SIPs versus you guide them. This is the thing which would give you confidence that the SIP stoppage ratio, right? There are 3 bars there. Look at the 2025 bar. When people did on their own, 57% of the SIPs were stopped before they due. Whereas both through MFDs and this, that ratio was 98 and sorry, and then I just said it the opposite way. The stoppage ratio was only 57% with the MFDs, but 100% with the direct digital and others. right? So clearly, the fact that as an MFD, MFD industry has been adding value is clearly shown. This should give you confidence that to tell the customer that they're trigger happy when they see a fast rise, they want to book profits, or they see a 2 months of downturn, they want to exit and get out. These are the place where your advice and this will be valuable, right? And then you move to the next slide, where I want to summarize that what you should attempt to do over all of this is that from your side, over and above what the fund managers delivers, the market delivers, and the MFD industry delivers, you should look to add a 2% from your side by all of these things that I said. Choosing sectoral funds, choosing alternate funds, choosing the right fund managers, right? Choosing mix of active passive, you should be able to add a 2% CAGR to the customer's portfolio and naturally your AUM. So that means what? From a 16%, you remember it was a 12% was the nominal GDP growth over the next 16 years. As a 2% alpha will be added by the stock market, makes it 14. As a 2% alpha will be added by the fund management industry, which makes it 16. And the 2% that if you add and if you grow it, then your AUM can grow at 18% per annum over a 15-year period, not 18% every year, but yes, on an annualized basis. Why am you saying this is what this means is that the rule of 72, the rule of compounding means that your AUM can grow 16 times in the next 16 years. So if you are a small MFD managing 6.5 crores, if you do this all well, you should be running a 100 crore book in 2041, which is 16 years from today, right? So that's the size of the opportunity from the next slide of the Viksit Bharat. Equip yourself and grab it with both hands. And now I hand the floor over for Asset Plus to give them some bit about how they can help you in this journey.
Thank you so much, Sunil. Thank you for such valuable insights. I'm sure, like you mentioned in the beginning of the session, that your perspective does not just help people who are already in the mutual fund distribution sector, but also people who are planning to enter the industry. Now, as the ones who are already distributors, already mutual fund distributors, for them, we would request you to stay tuned, because we would basically tell you what Asset Plus is going to offer you and how they are going to help you to scale your business. And for the ones who are already planning to become distributors, I'm going to now tell you how you can start your process with Asset Plus Academy. So first, I'll start with your journey. There are 3 very simple steps to becoming a mutual fund distributor. The thing is, you can become a mutual fund distributor by the end of this year, literally. Okay, so you just have to clear the NISM 5A exam, which consists of 100 MCQs. It's just 50 marks passing. There's no negative marking and 1,500 fees. We at Assetplus Academy provide free training to basically help you clear the exam. So if you are up for it, we are going to tell you more about it in the next few slides. Now, the second step is to get your ARN, that is your AMFI registration number. This basically requires your basic documents like PAN, Aadhaar, and NISM passing certificate, and there's a fee of 3,500. This is basically the license to practice as a mutual fund distributor in India. Now, the third and the final step, the most important one, that is starting your mutual fund distribution by empaneling with a national distributor like Asset Plus, or you can also empanel with any number of AMCs as you wish to. Now, coming to how Asset Plus is going to help you clear the exam. Okay, so we literally have created this training courses that will help you clear the exam very smoothly. So the first one, we have a 14-day guided training course wherein you get live classes directly from expert trainers that covers all 12 modules of the NISM 5A syllabus. These are classes of about 1.5 hours, and these will include mock test and Q&A sessions directly from the trainers. Now, our next guided training session is going to start from January onwards. So if you want to start your new journey in the new year, this is your cue to start that. Now, we also have a second course, a training method, that is self-study course. So if you are actually planning to give your exam by the end of this year, then this is appropriate for you. You can start your course, self-study course, right away. You just have to register with us for the self-study course. There are recorded classes, pre-recorded sessions that includes mock test, study material that is going to help you clear the exam smoothly. We also have a third training method where we host 1 day live workshops. These are basically in person sessions led by expert faculties, and these are like intensive prep for NISM 5A certification. We are doing a nationwide drive across 25 plus cities in India. So we will be posting updates on the next cities that we visit. We will let you know if in case we're visiting your city next. Now, the big question. Once you have cleared the NISM exam and you have received your ARN, you have basically received your driving license. Now, with this driving license, you have to go places. You have to move forward, right? And for that, you need the right vehicle, and that's where Asset Plus comes in. Asset Plus is going to help you scale your business, and we are going to be there so that you can grow your business to the extent that you want it to. Now, coming to why Asset Plus. So, first of all, we would like to tell you that Asset Plus already is a India's leading fully assisted digital platform for wealth management. We have currently over 17,800 mutual fund distributors who are already with us. And on top of that, we process 5 lakh monthly transactions every single month. Now, one very unique thing about Asset Plus is कि हमारे जो founders हैं, Mr. Vishrant and Avinish, वो दोनों ने खुद, like they also started their journey as mutual fund distributors themselves. So basically, they have the first hand experience on what challenges or difficulties that any mutual fund distributors face. And on like basing on that challenge and basing on their experience, they have created Asset Plus to solve all the challenges that are faced by any mutual fund distributors on everyday basis. And of course, we are backed by some of the top finance investors in the country. I'm sure you'd be aware of Nitin Kamath of Zerodha and Rain Matter, then Bhupinder Singh of Incred, and also we are backed by 8 Road Ventures. Finally, so you can basically be assured that you are in good hands because we are also trusted by some top players of the industry. Now, we are not just going to give you a platform, we are going to give you a platform for you as well as your investors. So once you join the Asset Plus app, you get a platform for yourself, that is the partner app, and one for your investors, that is the investor app. So basically, you have a complete visibility, both you and your investor, to run the entire business and also help your investor at the same time. Now, we do not just hand you over a platform and leave you on your own. We are obviously going to help you, support you, scale your business and grow it. Just like Sunil said, there's one very important thing about being a mutual fund distributor. So आप जब एक म्यूचुअल फंड डिस्ट्रीब्यूटर बनते हैं, आप जिस एक डिस्ट्रीब्यूटर ही नहीं बनते, आप एक फाइनेंशियल एडवाइजर भी होते हैं. सो एज अ फाइनेंशियल एडवाइजर एक बहुत इंपॉर्टेंट चीज ये है कि आपको हमेशा इंडस्ट्री ट्रेंड्स के साथ या फिर इंडस्ट्री में जो भी चल रहा है उसके साथ यू हैव टू रिमेन अपडेटेड विद ऑल द नॉलेज. एंड दैट्स व्हाई वी हैव क्रिएटेड अ comprehensive resource hub where you get access to all kinds of YouTube videos, podcasts, then webinars, and then expert sessions like this, taki you stay updated and you can also help your investors in the process. Apart from this, like Sunil said, there's another thing, that is you have to increase your visibility. Your visibility is what matters, and that will basically help you get clients on the way. So to help you with that, we are going to help you with marketing. And marketing does not just mean digital marketing. We are going to help you with your physical marketing as well. So if you want to do any kind of video content production, if you want to do posters, banners, or infographics, we are going to help you with all of that. Apart from that, if you are planning to host IAPs, that is investor awareness programs or corporate events, we will help you host and organize those as well. If one thing that matters is building a brand. So to build a brand, you need a website. And to build a website, we are going to help you with that too. If you want a proper design website for yourself, for your brand, Assetplus is going to be helping you building your website as well. And as mentioned previously, we are going to help you with your physical marketing as well. For example, posters, banners, visiting cards, anything you need, we are here to help you with that too. Finally, uh, we have almost come to the end of our session. Thank you so much, everyone, for joining in. Thank you so much, Sunil. And for anyone who is interested in starting with your career as a mutual fund distributor, we will be sending out registration link for our training courses via WhatsApp and email. Please sign up and our team will reach out to you. And for those of you who are planning to explore the Assetplus app and empanel with us, we will be sharing the empanelment link over on WhatsApp and email, and you can sign up and explore the app yourself. I'll also be mentioning the link for our course link and the empanelment link in the chat box. If you want, you can copy and go to them directly. Thank you once again. We truly hope that today's session has added value to your journey. We will continue to bring such sessions, such more webinars, and more resources to support your growth as a mutual fund distributor. Thank you once again for joining us today, and we look forward to seeing you in your upcoming sessions. Thank you so much.